Well, I mean, I think we probably would return to inflation and policy and growth, you know, those big macro forces, and for what it's worth, if I'm not answering your next question, sorry, you know, we think on balance there is a positive story there. You know, certainly nervous about it. You know, we wouldn't be banging the table on it, but think there is scope for inflationary pressures to continue to moderate, and therefore that we are at or there or thereabouts in terms of sort of policy tightening, and maybe the ECB will review their strategy as well. And we think therefore markets could continue to sort of grind higher in conjunction with this sort of potential AI productivity boom that's capturing a lot of attention.
What am I thinking now, Ben? Right, what?
I don't say that on air.
Yeah. Well, thanks a lot for that. Let me ask you about bonds, because very interesting, you're talking about extending duration at this point. Is that 5 years? Is that 10 years? Is that 30 years? How far out do you think we can safely go now? Because effectively that's a call on the end of the interest rate rising cycle.
Well, I mean, we're pushing more towards sort of 10 years plus on duration, and in part that would reflect, we think, a moderating inflationary story, but also, look, on balance we feel quite positive about markets, and I did say we were quite nervous on that, but on balance we're quite positive. So if you have equities in your portfolio, like you're overweight that part of the market, you're going to need something in your bond portfolio to diversify you against those growth shocks. And they're not going to be a great inflationary hedge. I think we're well aware of that from 2022. But if we get, you know, that US recession comes sooner than anticipated, as we're seeing, you know, Chinese economic recovery disappoints, you know, that duration could help us out, given the preference for equities.
Right. Cash, how much?
Well, that depends on where you sit, but you know, cash levels would be marginally above benchmark, again on the basis that the inflationary threat, you know, hasn't gone away. So sort of overweight equities, underweight bonds, but longer duration, and then a little bit more in cash.
Where do you stand on the AI frenzy? We had our guest host earlier, Peter Toogood, who is very firmly on one side of it. He said, "Don't believe the hype. These are overdone. This is not the place to put your money." What do you think?
Well, I mean, I'll be sympathetic to that view. I wouldn't be so emphatic about it. I think it's important for clients to have some attachment to that narrative, that story. I mean, the productivity enhancements sometimes aren't spotted in the here and now. They're sort of quite exponential. So in the early days, the gains aren't really so obvious. But then things can happen quite rapidly, and so we could be on that point of the curve where AI displaces a lot more workers or jobs than we were anticipating, and it happens sooner than we think. And you know, markets are quite desperate for that story at the moment, aren't they? Because of the challenges we're seeing in wages and the jobs market. So you know, that could, of course, the timing of this AI productivity boom could well disappoint. So we wouldn't be, you know, swinging for it. But I think it's important to have for clients to have some exposure to it.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.